Well, welcome to the Australian Stock Market Show. Now tonight we dissect banks versus the tech stocks. Which one will deliver 10 to 20% growth in 2025? So stay tuned. I'm Dale Gillham and I'm your host, and joining me are Wealth Within's professional traders Janine Cox and Filip Tortevski. And together we're Australia's most trusted stock market educators. Good evening, team. How are we?
Awesome, and good to have you back.
Did you miss me?
Not that I loved having Phil in the hot seat. It was great having Phil there. And look, you know what? You might even vote in the comments for who you want there first. You might get kicked out.
She's already stirring the pot.
Janine, there's two things I know that are going to happen tonight. One is I'm going to put my foot in my mouth.
Yeah.
The second thing is I know you're going to shove it in further. That's what's going to happen tonight. What do you reckon, Phil?
I second everything you just said then. Yeah.
Well, anyway, first up tonight is our hot stock tip, Macquarie Bank, Phil, tonight.
Yes, important. Obviously, we had the rate cut happening today, 2 o'clock. So huge news, and what a time to be looking at a stock like this. So on your screen...
Hang on, before you go any further.
Oh.
We were both wrong.
Oh, yes.
And he was right.
Yes.
Of course.
And did he rub it in?
And right by a few months, can I say so?
Right by several months, yes.
Credit where credit is due, mate. Good job.
Because I write the thing for Finder every single month on what I think interest rates are going to do. So I'm ahead of the curve from you guys. Always something up my sleeve, guys. Macquarie Bank,
let's do it. All right, so on your screen now is the market index. And we'll get quick into this because everybody knows Macquarie Bank. Basically, what is quite interesting with this one, big market cap, 89.5 billion. The PE ratio is a bit of a focus right there, 23.86, and we just had a chat off air, Janine, you know, for a stock like this, growth driven, not such a high PE ratio.
No, I mean, it could go up to 27, 28 with Macquarie, but you know, time will tell. If it falls back down a little bit with this recent volatility, then that's okay too. But I'm pretty happy with Macquarie's PE at that level.
Yeah, absolutely. And a 2.74 yield obviously speaks to the fact that it is growth-driven company. So let's get into the gist of things and get on the technicals. And I want to start on the monthly chart here first because we've marked up a few things with Macquarie. Now, it's such an interesting stock. Obviously, this one, you know, is in a long-term uptrend, continuously providing value. It is trading at all-time highs at the moment. So if you're looking at this, you're probably thinking, Phil, hope you got something nice to say about this one because it is at an interesting level. But, you know, it's always when stocks trade to new all-time highs, it's so important to factor in how they got there and where they're sitting relative to, you know, just immediate to what's on the left-hand side of the chart. And we're going to get into that on the weekly chart. But you can clearly see what I've marked in green are the four most recent major pullbacks for this stock. And since each of those pullbacks, it's gone up 274% in 2012, 161% in 2016, over 200% since the COVID fall. Now, we've experienced another major pullback during 2022, and we're only up 56% so far, even though we're at new all-time highs. Now, if we were to measure that versus, or just go back in history, we're basically faltering around these levels through here. March 13, somewhere through here, and even somewhere through here. So there is so much more opportunity from a historical point of view on how much this stock runs after a significant pullback.
Great point.
That's the real important part for this stock. Now, the second part is how much further does it have to run in the short term? Because right now, I think Macquarie is more of a short-term proposition. Let's put that on the table more so than a long-term proposition, clearly because of where it is right now and how it has unfolded. So we are going to break the weekly chart down. And what is so interesting was what I mentioned earlier about the fact that looking to the left-hand side to see how markets get to all-time highs. Now, to put that into perspective, this run through 2021, very sharp, not much pullbacks all the way to that all-time high, which kind of signaled that the market was getting stretched. Fast forward to today, we're coming into a period where once breaking through to a new all-time high, we've started to consolidate sideways for many weeks or many months. We did a very similar formation back in 2024, consolidating and basically giving you that clear indication that, hey, sellers have had their opportunity. If they're going to get involved, they generally get involved at new all-time highs. They've had their opportunity, buyers have held it up, and we've broken through again. And these green dots basically represent that we're testing those levels. We tested it back on the 9th of August, the breakout from the congestion. We're again now testing a breakout from congestion. So I think a nice little run up past, if we zoom up to 270, is very much on the cards, 260 to 270. And the beautiful thing is you've got this very nice trend line supporting you as a protection on the way up. If it starts to falter through that trend line, then hey, you've got a very clear marker to show you it's time to get out.
So good upside potential, very low risk. That's really what you're saying.
Yeah, for now, and you know, on the back of the momentum with the rate cut, potentially could boost it even further. Given you know this one is one of those companies that does the acquisitions and access to more credit could be a good thing.
I'm with you, Phil. But that is it for our hot stock tip. Now, right now is your opportunity to get involved in the show and have your questions answered. So call now on 0392909988, or you can text your question to the number on your screen. Now, the first caller into the show right now gets a free copy of my book, Accelerate Your Wealth. So pick up your phone and dial 0392909988 now. Now, while you do that, Janine will give her analysis on the world stock market. So take it away, Janine.
Beautiful. Well, on your screen right now, we've got the DAX index, the Hang Seng at the top. So we've got 14.5% and 13%. These are the two leaders on the board at the moment, which is really interesting to see. Interesting that the Asian markets are actually creeping up there now, where we had the Asian markets really lagging. And that's what's exciting, I think. And we could see, it'll be interesting to see the Shanghai Composite, if it can manage to creep back up. Just in the green at the moment, it's come out of that red. So looking at that, behind the S&P 500 index, it's actually really close to that sort of 4% there. So, you know, a couple of percent on the Asian market, they could do it in a week, couldn't they?
Potentially, but what's interesting when you look at that list, I mean, the top five, it's Europe. Europe is leading the charge right now, and Europe was a lagger, you know, over the last couple of years. So that is quite interesting.
It's fascinating, isn't it? And the Australian market, whereabouts? Well, we're in the middle, 4.65, and that's a pretty good place to be, I think, for our market at the moment. Expecting more opportunities for our market and more growth towards the end of the year. That's definitely what we think for all ordinaries anyway.
Yeah, I reckon it's better than, because generally on average our market does 9% a year, if that 9 and a bit. We're already almost halfway and we're 2 months in.
But remember last January, we took off like a rocket.
Yeah, that's true.
And we were up into February, then we had several months where it wasn't looking that good for quite a while. And then we finished off the year strongly. So, I don't know.
Well,
is that a sign for this year, or we're
the
not
miners have done nothing, so there's a bit in the tank there from the mining sector still to come, and the banks, like we were just looking at Macquarie before, still more upside potential. People think that Commonwealth Bank's, you know, getting a bit high and overvalued, but look at it, its net interest margin was higher, its dividend was higher. So while CBA keeps producing those sort of numbers, who's going to knock it? I don't think they will.
Oh, I'm not knocking it. I'm just saying at the moment the market is looking really good for this year, but it was looking this time last year. It was looking really good last year as well. But you know, we've got a federal election coming up sometime soon, so don't be surprised if we don't get a second rate cut in the next RBA. That's my prediction. It's high on my thing. We'll probably get 2 quarter points, because I'm sure the government wants a second one to make everybody think they're better than what they've been actually doing. But I'm not going to get political on everybody. But to me, I think it's a good time for it.
I mean, one thing that's interesting to think about is there's been a focus shift to the US market for a while because of the incredible run that it's had. And now that our market is actually poised and is in the middle of the board, I think this is where we've got the opportunity to race ahead. Can you imagine if the miners take off and what that's going to mean for the Australian market going forward? I think there's going to be a lot more money shifting back.
But our market's often in the middle of the board. And to me, that's why I love our market better than other markets, because you don't have the same volatility. Because with big wins comes big losses. And so if you've got something that's steady, it's easy to trade and you'll make far more money out of it than taking big hits all the time, which is what a lot of people do.
Well, the thing is, they're not thinking about how far the market can correct. And we know in a correction that the Australian market tends to be less volatile than the US market in those pullbacks. And so what's going to happen in the next major correction on the US market? Markets tend to fall 50%. The US market can fall up to 80% when it has its pullbacks. So if it falls 50% and it does it really quickly, I mean, just watch what will happen in our market if it falls less.
Maybe there's a
whole
lesson
show in there. There's a lesson in there for buy and holders, that's for sure.
Most definitely. Well, that is it for our thoughts on world stock markets. Now let's dive into more stocks and answer your questions. Now, Jules writes in, hoping you'll have a look at NextDC for me. It has pulled back from the all-time high around 20% to an important support level, as well as one of Phil's momentum lines. Just your momentum lines.
It used to be yours.
It used to be mine. Anyway, I like the fundamentals of the company, and I'm waiting for confirmation of my back-tested rules that could potentially trigger in the next few weeks. Have a few months off and people take your rules.
As long as that's all they've taken.
Would you like to answer the question then, Janine?
Look, how about not really?
Okay, we'll ask Phil then.
I guess if I have to, right? All right, let's get into the charts of next DC for you. What's interesting to me is that the momentum line that he is mentioning now, rather than supporting the momentum line, the one I've got drawn through here, the stock's actually breaking through it a little. Now, you know, that in itself is an important point to keep in mind. Not only is it breaking through it, it's come back and tested it, gap down, and now it looks like a second bout of buyers having a go to take price higher, failing. But we are seeing a bit of price action through here, which indicates some kind of reversal on the cards. I mean, we saw a close above the open on the week of the 31st. We saw a very strong close 2 weeks ago. Sellers came through, but now we're seeing buyers pick it up again. So I would argue, whilst we're holding above this momentum line through here, it's not as bullish of a scenario as we, potentially anticipating. But the fact that the stock has come off 20%, that's a healthy pullback, a very healthy pullback, given the nature of this rise. So expected. I mean, the market went up in 1 month in February 2024. You can see that volatility, more than 3 times or double the amount of natural volatility. So it's only natural to pull back to around those levels. What I would argue or say is you also do have the ability to apply a momentum line on the flip side. Now, that's where you get the real power of identifying that reversal. You know, we always talk about waiting for that confirmation. Yes. To me, that confirmation will come once we break through this momentum line here on the downside. Then we can start having that conversation that next DC looks exciting again.
Yeah, but that would only be the start of the conversation, wouldn't it? Because as you say, you've still got this line coming up from underneath all of that. And there could be a pattern that some of our students will recognise as potentially there in that at that high. So whether that actually unfolds or not is confirmed.
Well,
but you know, we're still so close. Yes.
I was going to say I went the PG version. Janine's gone the technical version.
The PG.
She
Love
just
it.
wants to have a boxing match.
but it's a great point. Exactly what you're saying. It's more technical, but it's a fantastic point. Yeah.
Oh, thank you for that. And looking at this line across here, we still have a little bit of a way to go if it wants to come back and find support on there. So like you say, it's not a done deal just yet.
Yeah, and nice volume coming through, by the way, so keep an eye on that as well. That could be signalled the blowout near a low, something to keep in mind.
All good thoughts for you, Jules. Now, next up is Scott, who writes, would love some advice on what to do with a stock like Bendigo that has had a nice run but got completely obliterated today on the half-year report. How does one trade around this kind of movement? I'm still up 29%, so do you just take the money and run or hope that things settle and recover somewhat? I'll go to you, Janine. You're the banking queen.
Look, I guess this is one of those cases where, you know, and I feel for you, you know, you've had a great trade, it's trended really nicely, good stock, and yet, you know, it's been sold off so heavily, but that's what happens at reporting season. It can happen to even good stocks. So I don't think it's something to get too upset about. I think it's just a learning thing, and you've got a profit there. So I would stick with whatever your rules were. You've got obviously got a stop loss. You have a trailing stop loss. Your initial stop loss hasn't been triggered because you haven't gone below your buy price, so that's great. But looking at this fall just in percentage terms, that's probably an important thing to have a look from the high. It's actually dropped to around 20%. Now, it's quite normal for stocks to come back 10, 15% before they actually trigger their exits, because they could just come back and like it did here, had a breather, turn around and go back up again. So it's, you know, it's a bit of a line in the sand. What do? You can actually make a choice as a trader. If you've put a line in the sand, say your stop loss was underneath this low, obviously it's closed below it, get out. That would be the decision to get out. But if it actually closed back above, say you had a weekly close and you're waiting for that, maybe it closes above it for the week, you might decide just to wait and see whether this is just a bit of a storm in the teacup, an oversell, and maybe it's going to come back up. But you have to also think about what good news is possibly going to come out after that, you know. And I actually always go and read the report just to see what they're saying, just to find out how much depth is in that, because it can be that, you know, we get these huge sell downs, but then the stock turns around and goes back up. At the same time, I don't want to give you any sort of false hope to think it's going to happen in the short term. So Sometimes the bird in the hand is worth two in the bush, isn't it?
Well, how many times have we seen something like this happen where it just reverses over the next month and goes right back up to where it was before because the big sellers just come in on the announcement?
But then how many weeks could it go down before it does that?
Well,
and
that's
then,
possible too.
You know, do you keep sort of saying, well, I'll just lower it down a bit, and then it
You
can't. You've got to just draw the line in the sand.
But how many times have we seen that? But also, how many times do we see a stock before it does this, telling us that it's going to do that?
That's true.
We also get that, and that's obviously the benefit of having good rules around things. And I'm not saying he doesn't.
This one was a little bit different because it actually had consolidated sideways, but there was no sort of real solid exit in there to get out. So, it's a tough decision, but some of these have to be made, and at least you've got a profit on that one. I would look at on the positive side of this one.
Right. They bought right. And to me, it's just the market too. The market will do that. But it's not common that it does this to you as when you're trading. But anyway, all good comments from both Phil and Janine. Now that's our take on Bendigo Bank. Now's the time for us for our topic for tonight.
Last year, the Australian stock market had two standout winners, the financial sector and the technology sector. So, should you place your bets on the same horses this year? The financial sector delivered an impressive 36% return in 2024, including dividends, largely driven by the big four banks. Westpac led the pack, rising 41%, with Commonwealth Bank not far behind at 37%. However, the story wasn't as strong for NAB, up 21%, or ANZ, which managed only 11%. Could this year see NAB and ANZ taking the lead? Now, onto the technology sector. It outperformed with an astonishing 51% return, including dividends. This was driven by heavyweights like Westpac Global, which surged 60%, Xero up 50%, Technology One skyrocketing 103%, and Life360 reaching the moon with 198% return for the year. This sector is fast moving and volatile, but can it maintain the momentum this year? As with so many aspects of the Australian economy, interest rates play a pivotal role. Banks and financial institutions thrive in a higher interest rate environment.
The Commonwealth Bank has posted a record full-year profit of $10.2 billion, and Chief Executive Matt Comyn earned a massive $10.4 million.
Last year's high interest rate environment gave banks the boost they needed to perform exceptionally well. In contrast, the technology sector usually faces challenges in such environments. Higher rates increase the cost of borrowing, which can dampen investment in growth, research, and development. Yet, technology stocks often move on speculation rather than fundamentals, as we saw with last year's extraordinary gains. If we go through a period of rate cutting this year, it might seem like banks could struggle while tech stocks would thrive. But is it that simple? The relationship between interest rate cuts and sector performance is more complex. While banks might face headwinds from lower interest rate spreads, they could benefit from higher loan activity and improved asset quality if rate cuts stimulate the economy. On the other hand, technology stocks could see a boost in valuations and funding conditions due to cheaper borrowing. So, where should you put your money in for the best returns? Let's start by taking a quick look at the price to earnings ratios of the big four banks. The PE ratio helps us to determine whether a company is relatively cheap compared to its earnings. For reference, the PE ratio of the ASX is 21.74, whereas the PE ratio for the financial sector index is 19.05. So, any company within that index that has a lower PE ratio than that would be considered cheap. Looking at the data, CBA stands out with the highest PE ratio and the lowest dividend yield. This reflects the significant price increase last year, outperforming its peers. In contrast, ANZ has the lowest PE ratio and the highest dividend yield, making it the most affordable of the four. These metrics suggest that 3 of the banks offer strong value and income opportunities. Now, let's shift our focus to 4 of the largest technology stocks by market capitalization. Here, the PE ratios paint a very different picture. Westpac Global has a PE ratio which is more than twice of that of the Information Technology Index. While Technology One does look expensive, it is the cheaper of the group, with a PE ratio a bit closer to that of the index. NextDC has a PE ratio of 0, as it is not yet profitable. This might seem extreme compared to the banks, but it's typical for tech stocks which are primarily growth focused and valued on their future potential rather than their current earnings. So, what's the key takeaway? Well, both sectors have their strengths. The financial sector offers steady returns through reliable dividends and relatively attractive valuations. Meanwhile, the technology sector provides exciting growth potential, albeit with higher risks and valuations. A balanced approach might be the best strategy, combining steady, dividend-paying bank stocks with high-growth tech stocks to capture the benefit of both stability and potential upside.
Janine, I'm going to go to you because you're the banking queen. Now, what Pedro was just presenting there is 3 out of our big 4 banks look cheap.
I wouldn't say cheap.
Oh, so what would you say?
I think that
Cheap, very cheap.
Good value is
Good
probably
value.
a better way to describe it, isn't it?
Okay.
However, when there's a drop in interest rates, you know, he was talking about what that really means. And it's interesting because although there's likelihood of more people coming into the market looking to borrow, it means that bank competition around these times increases. So there's a bit more of a war for the market share. And this is often when some banks can actually tip the scales on other banks and take market share. So they will be hustling for that. So that means that their margins could actually drop slightly over that time, potentially. I'm not saying they will, but there's a potential for that. And the market pays extremely close attention to these things. But let's come back to the charts because that's where we want to play. If we're looking at the charts purely, 3 out of the 4 banks, while they may look cheaper than Commonwealth Bank, I think that for a short term, as we've been saying, Commonwealth Bank still has a good upside potential. I think that NAB still has some potential to go through its all-time high, but ANZ, it's way from its all-time high. It's so far below its all-time high, so we see a huge opportunity there. Once they bed down the acquisition of Sun, I think that ANZ will be a good one.
Okay. I'm going to go to you now, Phil. I'm going to talk about tech sector and Life 360. One of those ones that reminds me what an idiot I am sometimes. Because I told everybody else to buy it ages ago and I didn't.
Yeah.
But we've all done that.
Yes.
So do you think tech and Life 360 have still got more to go?
Well, I don't know so much about Life 360, but tech itself, that space, given we are potentially moving into this easing cycle, you know, access to more credit, it bodes well for these stocks, the players. Even, you know, stocks outside the top 200, so the small cap stock space benefits from what is happening with the rate cuts. So I would say, is it possible? Sure. The tech sector is continuing to go on, but remember 2000. So at some point we do get scenarios where
Still in nappies in 2000, weren't you?
I was getting there. I was starting out, but you know, you've got scenarios back then where the valuations were way out of kilter with prices, and they did come back to some normality. We are seeing that out in the US now. Some of the big tech players are starting to come off, and so just be wary of that because at some point that situation will align. But right now, I mean, geez, you can't fault it.
No, it is good. And I want to get into the comment that Pedro made about NextDC, not making profits, PE ratio 0.
Yeah.
Good or bad?
It happens with these players. I mean, because like Pedro said, it's all about that expected value, right? If they've got a technology that the market is so hyped up on, I mean, you know, Airbnb at one point, a lot of these companies, they were, you know, not making money and
Uber, Amazon, you know,
you name them.
Apple, others, all weren't making money. Some of them for years and years and years, not making a profit. There's probably still a few big ones now.
Zip, I mean, Zip's a big example. All throughout that period, I mean, it's still not making money, and that's had some wild price swings up. Naturally, it's fallen away, but starting to rise again. So it's on that expected value with these tech players.
I think you want banks for your dividends and your income, a bit of a balance there. And tech's different. Tech's just going to be purely about growth. So it's a different consideration when you're looking at both.
So is there room for both in your portfolio?
I think so.
Oh, yeah.
Yeah.
Oh, yeah.
So more banks or more tech or a bit of a balance?
Balance.
Bit of a balance.
I'd go risk profile. I mean, if you're looking for purely more of a growth focus, I would lean more to the tech space, but with more reward comes more risk.
That's correct, and you're going to get more volatility in those spaces because we see that with tech.
Yes.
Yeah, just look at how far they pull back. That's really the giveaway, isn't it? We just looked at NextDC and how far it's fallen versus some of the banks when they pulled back.
Yeah, you got to have the stomach for it because
Forget about Bendigo Bank in that comment.
Yeah.
So, but you're right. I mean, people often will buy a stock, but they love it when it's going up, but they can't handle the big falls come the other end. So that's really what Janine's saying with your portfolio construction, and obviously what Phil was talking about too. You know, looking at that risk and what you're doing. But now I know we need to get into some stocks, so I'm pretty sure you got a whole lot of them.
Yes, we've got plenty. All right, so let's start off with the bank index. Now, we're not talking about if we go on the charts and have a look, we're not talking about the financials. We're talking about specifically a subsector, which is the banks, S&P 200 banks industry, which is the code XBK. Now,
Commonwealth Bank's going to dominate that because of its size
naturally,
relative to the other
yes,
banks.
Absolutely. And I mean, look, it does kind of resemble a little bit of what we saw during, with Commonwealth share price, that huge consolidation sideways and now breaking on up. But I mean, it's not only Commonwealth in this picture, there's quite a few in there. And right now you've got to ask yourself that question with this sector. You know, that's the overriding question and conversation that has to be had. How much more does this market have? And the way it's moving, I see nothing wrong in this momentum on the weekly chart. When you see a trend that is met with buyer and seller activity, healthy buyer and seller activity, and it's consistently making new highs, that's a healthy trend. Unhealthy trends are at the height of euphoria where you just see it skyrocket in a vertical line, no seller activity, just buying, and then that's the warning sign. That's the red bell saying, hey, we're about to turn at some point. Drone shield, you name it. We've had many examples. This doesn't look that way. I mean, at the all-time high through here, we've just come through a pullback and now we're back into trend.
So keep it simple is what you're saying.
As long as the buyers and sellers are getting involved and we're getting nice waves up and down, I think it's
all right. Let's move on to the next stock chart. Which one's this?
All right. Next one is
tech.
It's tech.
Okay, tech stock is exactly what you were talking about before in terms of that volatility, and I just want to switch straight to the monthly chart so we can see that. But interestingly, the recovery out of COVID was so strong and then nothing for all that time. So it went from December 2020 all the way through to January 2022 and then just dropped out of bed. So the falls on this one were significant, you have to say, compared to what you would typically see in banking. So 50% fall, and we're not in a major market correction. You know, that's saying something. That is warning you about what could happen when there is a big correction on our market and the percentage fall. Now, think about that in terms of the US stocks, if they're, tech heavy and how far they might fall. If you're trading those, look at those. But as far as the Aussie stocks are concerned, we've had this nice run up, just gone through that high, which is lovely to see. And there's no sign right now that it's going to reverse. If it takes out last month's low, I'd be thinking differently if it takes out January 2025.
You know what screams out to me on this chart is look how the characters changed of this sector. I mean, we got that magnificent 7 out of the US that, everyone's started talking about tech. Yeah, and I think that kind of filtered through to the rest of the world, because before that, look at the volatility, the monthly volatility, the bars are so small. Then we get COVID. Post-COVID, they're so volatile. I mean, this sector is crazy.
Because Australians were playing sheep, if I can say that.
Yeah.
Because tech was going in the US, so they go, well, tech's got to go here. So they were buying on what I would call speculation, not necessarily good fundamentals and even good technicals, which drove some of those really high, which saw that correction, the 50% correction. Because eventually it gets too high and it falls away. So that's what we've got to be worried about with tech. Getting on good tech stocks, because most of our tech stocks aren't huge stocks like the banks. So they're going to be a little bit more volatile, and they're going to get thin on the ground as you get past the top 5 or 10 of them too. Good ones anyway.
Oh yeah, spot on. All right.
Next chart.
Should we get into some stocks? All right. First up is Commonwealth Bank. Now, obviously the biggest player out there. And again, what is quite interesting with this one now, when you're looking at this chart, you're looking at it and you're thinking, okay, sharp move up, not without seller involvement. And that's the promising part. And I'll stick to the weekly chart here just to keep it nice and simple. But we're coming into a period like we saw back in February 2024. And if I can get...
While you're doing that, can I just add to the conversation a little bit? I mean, what was interesting to me is this same sort of pattern that we're seeing here is exactly what we saw on Ben before it corrected. And yet CommBank's just shot out of the top of that instead of falling away from it. But the thing you've got to bear in mind is that often in the past, the smaller banks used to actually lead the larger ones. This was until some years ago. Remember, we used to always look at second-tier banks as a signal of what could be happening in the larger ones. Right now, we're seeing Ben drop off. BOQ's yet to report it later, I think this month or close to that time. And and Commonwealth Bank stayed steady. So while I do see more upside, and I'm sure you do too, in Commonwealth Bank, maybe the smaller banks are a bit of a precursor for something.
Look, potentially, but the other overriding thing that not many people are talking about is there's got two levels of flow coming into these big players. I mean, ETFs right now, index ETFs, are the thing that everyone is jumping into. And what do these ETFs buy? Obviously, the underlying top 100, top 20 majority, right? So there is so much flow pumping into these big stocks that you're seeing the second tier stocks that are providing the real value, you know, undervalued stocks, good earnings, they're not getting picked up. So,
well, look,
question.
Shall we move on to the next one?
Absolutely. You took the words right out of my mouth. According to Meatloaf.
Talking about banks. Westpac is another interesting one. Now, it got sold off a little bit on reporting, so it may end up coming back, obviously not as hard as what we've seen with Ben, but that's okay. I'll be quite comfortable for Westpac to come back because it's doing what we'd expect. There's a bit of a resistance level across here, so it's nothing uncommon to see that occur. Could it take out this low? Possibly. And we just need to wait and see whether it consolidates under that level, because sometimes that can happen before you get another break to the high. But there's still good upside in this one. I mean, we haven't even gone through that high yet, and there's still another 15% to the high, plus whatever it makes above that.
Yeah, I can never understand when people say, you know, banks are boring or slow. When you look at the way banks move, this is a monthly chart.
Well, just have a look at NAB. Remember, we used to laugh about NAB, how it had done nothing for 10 years or something. That sort of made us think differently for a while.
Yeah. Well, look, that's fair enough. But I mean, even within those moves, there is enough volatility just on the big banks. And as we just mentioned, you've got that in your back pocket that there is liquidity pumping through these stocks consistently. I mean, from a trader's perspective, opportunities galore. And it's not surprising that given this huge sideways period here, our students would know this is a very technical pattern that had formed, that congestion. And it's normal for the stock to be doing what it's doing, breaking out. And I'm with you, Janine. I mean, it's at resistance right now, but if it can hold, and it's not giving any signal. If the sellers were going to get involved, all right, this month.
That's monthly though.
Yeah, this month it's starting. So let's see. But I mean, they're kind of compressing just under the level. So line in the sand for Westpac as well.
You've got to say that Westpac's not going to have any major pullback because it hasn't gone through its previous all-time high from 2000.
Well, it could, because volatility as such in the, you know, we saw huge volatility if we just go back to the sideways moves in 2021 and back here in 2022. You know, it can surprise to the downside. So it's got to be mindful that, you know, sometimes we can see bigger falls than what we expect on some of these banks, and then it recovers. So there's 20% falls, but it was still part of a sideways move. So that's just the AI playing with, you know, our banks, really.
But the beautiful thing
algos.
Let's not go there. The beautiful thing with these stocks is even if it does fall away 20%, you know, given we've turned the corner now, we're in an uptrend, you're not going to get that crazy tech type movement, 40-50% gap down on some of the plays. This is going to be a pullback, but you're going to be able to manage it.
Yeah, right. Okay, great.
Next one, is it?
NAB's another good one, isn't it? You know, this is the one I was talking about before, where for years we thought it was the dog of the banks, really. I mean, just have a look at this.
I almost renamed it dog.
Yeah. Well, Telstra had the flag for that one, didn't it, for many years? And now we're looking at NAB doing the same sort of formation as Westpac, although it actually had a much bigger rise out of that COVID low, but it's closer to its all-time high now. So again, a resistance level that we're expecting, and then we just need to wait and see the price settle down. It hasn't pulled back too much yet. A pullback this week, that's neither here nor there, but it could just track sideways for a little while. Let me just see how far are we from that. So from this high up here down to the low there. So there it's not even 20 to there, it's 13% to that low there. So let's just wait and watch NAB.
Yeah. Look, I agree with everything you're saying. I mean, and the way it's doing it, that's the most important thing. We, you know, looking as the stock is running up, we're breaking up, and now we're giving one of those congestion patterns, consolidations, with a move up. So it's very expected that we're going to get a pullback now, potentially pull back into this $38 level. If it holds, that is a big clue that we're getting ready for the next leg up.
You know, I mean, housing affordability is a big topic at the moment, and recently the government came out and they've said that they would put restrictions on overseas investors buying existing homes, which obviously they're trying to push them into the new homes and
Band-Aid.
and free up those. Yeah, they've
It's a
admitted
Band-Aid.
they've admitted it's a small part of an overall plan. And so the other part of that, one other part of that is that they're actually trying to get the banks to reduce the criteria on people who have student loans. So they should not be looking at that loan in the same way, given that and how that loan is treated in terms of when you have to pay it back.
So we can
So
just
just
we
watch
can have
though.
an argument on this one. but
We don't need to
get
have an
to another
argument on this
stock.
one at all, because we just simply wait and watch what the decision is on this one. And if they go ahead, it's just another tick in the box for me to say where we are in the overall cycle. That's all I'm looking for.
Let's go to NAB.
I'm not going to weigh in on the political
Otherwise, we'll
argument.
keep going.
ANZ, yep.
ANZ, sorry, we're on NAB.
All right, ANZ, last one. And again, I mean, look, this one in terms of potential, probably more than the rest, given it is lagging when we're looking at the all-time high up around $37. It's currently trading at $30. And I mean, you know, let's just bring up the monthly chart here on this one, because it has experienced a bit of a sell-off, as you can clearly see, and now we're coming in to test that level. But what's quite nice, all throughout this uptrend, we are seeing those high highs, high lows. We're still yet to take out the August 24 low. As long as we hold that low, for me, this uptrend holds firm. What is a little bit, I guess, worrying right now is the fact that we've started to come up in January, now February, and we're pulling away down. I'd really like it to get its head above November 2024, and that'll give a lot more confidence to that resumption of the uptrend, because that's where it's heading. Right now, it's looking like it's going to head back up to that $36 level. Potentially, there is some resistance through.
Look, I'm with you. I'm bullish on ANZ as well.
Yeah.
Same sort of thing, like you say, there's a resistance level there, but decent upside to the all-time high. With ANZ, you know, it's had a checkered history, as you know, having been in the banking industry in the past, to know that ANZ, you know, has struggled at times to actually succeed in launching projects and then actually getting those to really take off for it. It's now taken over Suncorp, which, you know, on one hand, I think it's awesome for ANZ, but it's just the time of the cycle that we're in that I'm really a little bit concerned about. I still think it'll be earnings accretive and make the share price take off once all of that gets, you know, bedded down. But I have a time limit on that, and obviously once we go into a market peak in the next couple of years, 2 or 3 years, then you know, this is obviously going to bear the brunt of that potentially.
Quite possibly, but at the moment everything seems to be more bullish.
What will the Olympics? The question in my mind is, what will the Olympics, the impact of the Olympics have on the Queensland
Next chart,
property
Phil.
sector?
Next chart, all right, we're going off track, yeah, all right. Westpac Global, now this is one of those tech players that obviously, you know, has had a fantastic time since 2020, ripping higher, and again, giving you that formation. Buyers met with sellers, buyers, sellers, and that was sustainable. Now, when you look at it, this is some real crazy volatility that we're seeing. August 2024, September 2024, it literally just jumped out like a rocket. Double the volatility that it experienced all throughout its history, and we get a huge sell-off coming through now. We've got some consolidation at $130. So right now, to me, this price action is so erratic, it's in no man's land. It's consolidating, but when you're looking at a stock at all-time highs, given the way the nature of these sellers have come through, this could be a period of distribution where we're, you know, trying to find that high, and there's that agreement between buyers and sellers saying, hey, you know, I'm not taking it any higher, and buyers saying, okay, we still think there's a bit of value around $123. I guess, deciding factor for me is very simple, and if we just apply one of these trend lines through here, you can see that we're kind of moved back
Momentum line, you mean?
Momentum line, sorry, I've ruined my own branding. But you know, as long as we can hold this trend line, this momentum line through here, we're going to see bounces up and down if this trend is sustainable. And there is that huge buying through there. So you can see it come back and get tested. We're starting to base higher a few times as well. If we start to break down through this trend line, I'm going to say that this is potentially one of those periods of distribution, and we've seen a top for Westpac for now.
Wow. It's interesting that big move up happened on low volume and the big move down happened on big volume, but
Yeah.
maybe that's telling us something. Anyway, but what's the next stock we've got?
Next we have Xero, another one that, again, looking, yeah, it's crazy. But looking at it now, I mean, you can take this one, but doesn't this resemble the period September 2020, the way it's run up over those 3 months? To me, that resembles what's happening now. It's that euphoric sell-off type movement. I really want to see on the monthly chart, I want to see some seller activity.
It was 10 months or something, isn't it, straight up?
Yeah, it's all green. So you got 1, 2, 3, 4, 5, 6, yeah, you're right, 8, 9, 10 months, only in the green, without no seller activity. We could be looking for a top here, I have to say.
Well, it remains to be seen, doesn't it?
No comment.
No comment.
But to that point, I just want to add, even though it is running, and if you're looking at the fundamentals versus the technicals right now, they're probably out of kilter as well. But when you're looking at it, when you see momentum and speculation in a stock, don't just throw it away, because there's opportunity. Right now, this is a trader stock for me, and potentially going down to that shorter term time frame and picking up these runs with a good structured risk to reward setup, you can cream it on the way up. So take what the market's giving you right now, but just be prepared. If you're thinking long-term scenario, well...
Possibly not on this stock at the moment.
Yeah.
Well, look, I'd agree with all of that anyway. So we got another tech stock?
We do, and I hope Janine wants to pick this one up.
Unusual for her to be so quiet.
Leave me the hard one. All right, okay, now, what we have to look at here is the angle. Now, Phil was talking before about the acceleration, and when you see an acceleration of the rise going up, and when you see the momentum change. So we've seen this angle coming up, and then we see it change dramatically. So that's a sign to say, okay, this could be the last part of the rise before we see another big pullback. So, we have seen stocks though, haven't we, that have done this sort of thing, and then they've just kept going. We've got to bear that in mind. But I would say, look, if you get some weakness below the low of this January 2025, I would be taking some profits. So, but this is monthly chart we're talking about. You might have rules if you're watching on the weekly chart, and that's fine too. You might have some different rules there. You might even be able to get a tight trend line up underneath all of that, it doesn't often happen on stocks when you get these sort of blow-off patterns happening. But obviously it's a long, long, long way from the trend at the moment.
Well, it's almost doubled in price in a year, less than a year.
It's
so
amazing.
It's got to slow
well
down.
done. Well done if you're watching and you had this one.
So we got the next DC was a stock we talked about earlier. So that's our next stock that we're going to talk a bit about.
Yeah, we can pick up a little bit more on that, because the previous question was more, I guess, specific to the email. But again,
what about some of the percentage falls that it has?
I mean, this one looks.
Ask a question.
Yeah.
Obviously, we saw technology one skyrocketing, and obviously, next DC is not making money, so it's got a 0 PE ratio. Do you actually, now at these sorts of points with these stocks that are going vertical or like next DC, do you actually look more at the fundamentals like your EPS ratios, your debt to equity ratios, and some of those other ratios to see, well, is this run over, and or is this about to fall away? Do we look at those?
You can look at them, but it's how much weight you're going to place on those depends on the strategy that you're employing. So, if you're purely technical driven, then obviously you're not going to put any weight on that, and you'll just be waiting to tick all the boxes to make sure that some really good rules have triggered and have a good stop loss. But if you want a balance between that, you can look at what's going on with, as Dale says, have a look at their debt. And sometimes stocks like these can have quite high debt. And that's part of the issue. The market's not comfortable with debt over a certain level. And often when it gets to around that 70 to 80% of equity, that's when the market can punish a stock when other stocks in the sector could be rising, which is probably what's happening here, because other stocks in the sector don't have anywhere near that level of debt.
But I mean, it's not just the level of debt, it's the serviceability of the debt, So maybe
well, interest rates have dropped, as you said before.
Yeah, and that might help. So, one good marker would be...
How many cuts are we going to get? If we get 2 or 3, maybe that'll help.
Yeah, and a bit of, a tip to look at any market, look at the free cash flow. That kind of gives you a good indication of how well that company is, And
when they're rolling over their
got
debt.
some on the side, and that too,
All right, all good points from the team to give you some insights into what you should be doing with both banking and tech stocks. Now, moving on, if you want to talk about a stock or ask a question, pick up your phone right now and give us a call on a 0392909988. That's 03 for Melbourne, 92909988. Or you can text the number on your screen now. Whilst we wait for your call, let's get into our next email. Now, Nick writes, could you take a look at Wildcat Resources? I don't own the stock, but it's on my watch list and it's not quite ready yet. Currently, it's a falling knife, but it seems to be testing the downward momentum. Once it turns around, it could present a great opportunity. This sounds like more like your type of stock.
Yeah, and it's an interesting one. So let's go and have a look at the chart. But to me, the big thing about this is right now the conversation is what's your risk reward, and how comfortable are you at accepting the risk versus reward in this particular scenario.
Sounds like you're being gentle with him.
I am, because you know what? Sometimes accepting the higher risk and being comfortable accepting that higher risk can pay off handsomely.
Yeah.
But it's not allowing that to ruin your psychology and then potentially not take a second or third bite at it if you are wrong, even though your rules might trigger. So that's the part that can be tricky, or you just wait for further confirmation, accept not getting the optimal risk reward price. But with these stocks, it can run away on you. So that's the other thing there. The volatility is quite...
So is he catching a falling knife?
Right now, not so much. Right now, if we go to the weekly chart, he's right. It's bounced 3 times exactly at 19 cents. Now, this third bounce is not yet confirmed. So, a very simple marker you could put through here is we're on that weekly chart. We're starting to get to a very critical conjuncture right now. So, I mean, looking at it, you're spot on looking at this stock today. And if we can pop our head above 27 cents, it is a riskier play, but albeit it is giving you the first sign of confirmation that we are turning the corner for the short term.
Yeah, I mean, I know it's a really important thing because often people will go for some of these smaller stocks to get that bigger return.
Yeah.
But as you said, they've got to look at that risk-reward scenario and say, okay, this is not acceptable. And it actually gives me a story. I was speaking to a trader the other week and we're talking about self-managed super. And he said, a fellow trader, he makes more money on his super. I've been disappointed in the last 2 years. And I said, well, what are you doing? And he said, I'm trading stocks, lower cap stocks. And I said, so your issue is you're a cowboy and you're not trading the right stocks for the right portfolio. And I said, I just trade on a monthly chart. That's all I trade. And I've kicked your ass on a monthly chart. And he goes, oh yeah, that guy does monthly charts only for the super. So it's looking in context and looking at that risk reward.
Yeah.
Because there's so much money to be made if you take the right strategy on that. And in this stock, obviously, as you saw, that chart looks pretty good actually.
Yeah.
But there's still a worrying sign, isn't it? Because it could go the other way.
Well, because last month it was sold off.
Absolutely. And you've got the overhanging with these resource stocks that any moment news can come out and completely decimate the stock, especially the lower cap stocks. But to that point, I mean, you raised a fantastic point. Go big picture. Even these stocks, people think you've got to trade them short term.
No.
Look at the monthly chart. Go big picture.
Sometimes they're easier on the monthly.
Absolutely. Much easier. Yep.
Well, anyway, now we have a text from King, and King says, hi team, could you please look at IMD? I don't own it yet, but it has a strong rise up to a resistance level, but it looks like it can trend well. Possibly looking at a long-term trade if it can get into blue sky territory. Cheers, King. I'm going to go to you, Janine.
IMDEX is interesting, isn't it? It's just trading near all-time highs, so I'm totally with you in terms of what you're saying. But sometimes these smaller stocks, you've actually got to trade them before they get there because, they can rip right through and then they can about face and come back again. So you'd have to really know this stock like the back of your hand before trading it. That's all I'll say. It goes up, consolidates sideways for many months and then goes up, down to test those levels. It's taken off beautifully. This is probably the best run it's had in quite a while. So I think you're going to be waiting a while. That's all I can say.
You were being nice there, yeah. Keep watching.
Janine's being nice now.
Oh yeah, he's missed the opportunity.
He's missed it.
Yeah.
Yeah.
Next one, he's got to wait for
There you go, King. There's the honest truth from both Phil and Janine, and both of them don't like the stock at this point in time now. Moving on to our next email, which is from Josh. He wanted to get your thoughts on FBR after the announcement and crash yesterday. I'm in constructions, so do have a strong belief in what the company's doing. Do you think there's a chance of the stock to recover if they can manage to secure funding via other means or partnerships? I bought in again after it dropped. I anticipate good news down the track. It will move in a positive direction, given they've already proven the efficiency of the machines. Interesting question. So it's multiple faceted.
There is a lot of facets. I would say that this is actually a beginner's mistake as the first thing. And I really, take my hat off to you for emailing in about this. It's a really good question and we thank you for that.
So the mistake is what?
The mistake is actually, firstly, buying something that's low liquidity without experience, buying on the story,
so and that's 2 mistakes.
And then doubling up or adding to your position
no, he didn't do that.
He bought more.
Oh, he bought more. Okay, I missed
Yeah, he
that
bought
bit.
more once it was already in a higher risk position. So that's the
So
challenge.
there's
here.
three rookie
deal with
mistakes you're
that.
saying.
Yep.
Okay, you're agreeing?
Oh, yeah, and the part about falling in love with the story.
Yes.
You know, there are so, I mean, lithium.
Yeah,
The
it's a
lithium
classic
story has
example,
been
isn't it?
going on for years, all whilst the share price is getting pummeled.
Mm.
And so marrying up your and that's the beautiful thing about charts and technical analysis. You get to see if the story that you like is actually being met with buyers.
But you know what? I mean, look, for a high risk specky sort of stock, from a chart point of view, we often say that these sort of patterns are a precursor to a takeoff, which it did. You know, this is the sort of thing that you see. There'll be something that comes out in the media. There'll be articles about it. They'll talk up the story only for then to see the price never reach that point again. Which,
Yeah, but with specky stocks, that's the other thing you've got to consider where you're playing in the market. You're playing in a market where a lot of these companies, they're looking for joint ventures, they're looking for capital, they need things to happen. It's not just purely going to be, you know, a buy and sell scenario from the market. So there are a whole bunch of other factors that you need to think
So
about.
you're saying know the stock a lot better than what he did.
And know the market, know that these things can happen. Because what happened was the news came out, it failed to secure a joint venture via an option. The other company said no, and obviously they, you know, kind of needed that to take that next leap forward.
Yeah, interesting if he was actually in profit.
The concept of what he mentioned, you know, we didn't put that up there, but the concept of the whole bricklaying automation is just amazing.
But don't
to
fall
think
in
they
love
can
with the
do that.
story.
That's true.
That's what Phil's saying, and I agree with that. Don't fall in love with the story. Anyway, we now have a caller on the line. Welcome to the Australian Stock Market Show. Who have I got on the line? Hello, welcome to the Australian Stock Market. Who have I got on the line?
Carl.
Carl, how you doing, mate? What's your question for us?
Good, thanks, Dale. I've been enjoying the show. I'm a first-time investor, and I was just curious about. I've been following this merge between Sigma Healthcare Company and the Chemist Warehouse, and I noticed it went up when it first came on the stock market last week, but now it's dropped down the last couple of days. I wondered if you thought it was a reasonably good investment.
So you're saying you're first-time investor. Does that mean you haven't bought stocks before, and this would be your first one?
That's right, yes.
Okay, so that qualifies.
I have friends who buy stocks, so they got me interested in watching the show and looking at the stock market.
Well, say thank you to your friends for us that you're watching the show, because I'm sure Janine and Phil have got some really good advice for you. One of the best things I can do or say to you is go to our website, pick up my first book, How to Beat the Managed Funds by 20%. It's free. You just got to pay the shipping, mate, and that will help you to understand what you're doing to get into the market. So if you haven't done that, go and do that. But I'll let these guys answer your question. Thanks for calling in, Carl. Who wants to take that one?
I think Janine's palming it off again.
No, she's palming. No, Janine, you can do it. First-time investor looking at Sigma for his first buy.
Carl, I don't know how to tell you this. It's the wrong stock, mate. No, you don't want to look at these high volatile stocks when you first get in the market. Second, let's just go back and have a look at the chart together, shall we? All right, lesson number 1. See these nice little consolidations? That's when the people who are, the smart money is buying when the risk is lower. So they'll be buying down in here, they'll be buying here, and they'll be selling up here. So that's really all I can tell you in a nutshell about this one. Now, in saying that, sometimes stocks can pull back. It might have its day again and then take off again. But right now, these sort of patterns tend to be what you see near tops, you know, where it's sort of pushing up like this. But I'm going technical again. And it might come back into that zone for a little while before we know what's going to happen next.
So let's give Carl some what should he be doing. So Sigma, you're saying
buy
no.
top 50 stocks on the market, stocks with nice trends, not the ones that are written up in tipping sheets or that your mates recommended to buy. Learn some basic rules to buy and sell and set stop losses to protect your money against people who are going to take it from you. That's really the most important thing.
You got anything to add?
Yeah, and I think, you know, just to add to that, we come from a perspective where there is a whole bunch of skill involved in terms of identifying the right moments to get in on a stock. Now, if Carl's idea is buying for a long-term proposition, you know, to hold for 5-10 years, the stock is $3 at the moment. If we go back to the chart, yes, it has run up ridiculously, It has a chemist warehouse scenario going through. It is trading at all-time highs. And so right now, from our perspective, from the technical side of things, it doesn't present an opportunity to buy. But long-term, big picture, you know, looking at these things that happen with stocks, sometimes
you could be buying the story again, like we were talking before, rather than you know what's good for him.
Well, but there is an actual conclusion on this one. The other one was in hope. This has happened, a merger which is...
They've merged already.
Yes.
Yeah.
So right now there's a whole new bunch of valuations that have to
But
come in.
the market's already factored it in.
For now, yes. So I would say the only advice to add to that is really hone in before you do want to get involved in the share market. What type of time frame are you going to be looking at? Are you going to be a long-term investor? Are you going to be a medium-term investor? And if you want to head down more the active route, then you're going to have to be looking at charts.
Yep, absolutely. That's why I suggested my book. But anyway, let's move on. Thanks, Carl, for your call. We do have a text from Tim who said, "Hi guys, can you please follow up your microcap video and look at VKT, VBC and AD1? Thanks, Tim." Well, we're only going to do one stock, which will probably be RKT, Tim, but thank you for your text. What do you reckon?
Yeah, this was an interesting one. I mean, I can't remember exactly. Can you remember what they were selling? RKT, Rocket DNA? Drones. That's right.
Yeah,
it was the
that was
drone
drones.
company. Yes. All right. Well, let's go to the chart. I mean, that's the most important bit, right?
Tells you everything, doesn't it? Look at it.
Yeah.
Well, we did those videos in early November. Two of them. So if you haven't seen them, go and check them out. They're on YouTube. Go back to November, and there's two videos, one after the other, where we covered all the stocks.
On our Wealth Within page.
Yeah, on our Wealth Within YouTube page. We covered all the stocks that we liked out of the Microcap conference. So
Yeah, great video. But I mean, going back to this one, again, it's one of those cases, know where you're playing. And right now it's not even 1 cent. And we're talking about a stock that is highly liquid. So you're going to get this huge erratic price action. Now, if I take all that away and look at it or analyse it from a technical perspective, it does appear to be giving one of these basing patterns. And that is quite interesting. Obviously listed, fell away. That does happen with a lot of new stocks. And basing out, it seems it's been basing out since 2022. The longer it does this, the more potential it has for a reversal. The flip side of that is the longer it does this, the more potential it has to stay sideways and potentially get delisted. So it all factors in with these players as well. It's not just the technical side of things. You've also got to be looking at, you know, when are they about to announce? How is the company holding up? Can it survive the next 2-3 years? Is there money coming through? Is it growing? So there's a whole bunch more in terms of analysis versus, you know, trying to trade a CBA over the short to medium term.
it is. I mean, both of you and I sat through their presentation
Yeah.
at the Microcap conference, and it was a really interesting story. But I'd seen them before. I saw them the year before, and to me, it was the same presentation, pretty much. Slightly different numbers, but same presentation. And what you're showing on the chart is nothing much happened in that 12 months. So what is the catalyst to send the price moving? You know, and I like their story. I really do like their story. Building drones, you know, they can, instead of farmers going out on hundreds of thousands of acres worth of property, they just sit at home with their drone, checking their cattle, checking their fences. Great stuff. They're doing in mines and checking safety for mines and pipelines, and there's so many different things that they'd use.
They
these
obviously
drones
need to
for.
just get more demand happening.
But they just need to get more demand happening, yeah.
Well, the only thing with this is that the barrier to entry for getting a drone license is not that high. So, you know, what might be hurting them in the long run is companies might just say, hey, you know what, we'll just get our own in-house.
We'll just buy our own drone.
Our own drone, our own pilot.
Yeah. And that's quite possibly what's happened. These are long-range drones. They're bigger drones, and they fly back to base and charge up with solar power and everything else because they dump this on a forklift, dump this thing in your paddock or whatever it is.
You know, but if you're a farmer, you don't want to have to be doing this stuff yourself. You want someone to be contracted doing it, don't you?
I'm not a farmer, I don't know.
No, but I'm just saying, like, you know, they're not selling the units, are they? They're actually selling the business. I think they're contracting themselves.
Look, aside from all of that, at the end of the day, the price is going to tell us, isn't it? It's going to really tell us if buyers are getting involved right now. It's going to show on the chart, or if they're about to get involved. And oftentimes what you can see, if there is going to be some market shifting news coming, you're probably going to see it in price in advance.
Really quick, yeah.
So-
Once it goes through that level, then you know something's happening.
Yeah, and that's probably the right level. You know, if we go back to the chart, that level right there, Janine, if it gets
Yeah.
through that, what is it? Not
1.8 cents.
1.8 cents if it gets through there.
It might be, I mean, you know, you might be onto a thing. Maybe in another month or so, we actually go look at all the stocks we looked at in the last video on the Microcap conference and see what's happened in the 6 months.
Yeah, good idea.
So maybe a good idea. So we'll keep that in mind. Anyway, remember to send your questions to info@wealthwithin.com.au and we'll answer them in next week's show. Now here's what's happening next week on the Australian Stock Market Show.
Next week in our main topic, we get into the top ASX ETFs for 2025 to outperform ASX 200 shares. If you love our show, remember to hit that like button now, subscribe to our channel, and be sure to tell us your thoughts in the comments. Thanks for joining us tonight. We'll see you next week on Tuesday at 7 p.m. For now, goodbye, good luck, and good trading.